Thank you very much, David. I'm from Chicago, which is actually colder than Antarctica right now. And it seems to be getting colder, whatever happened to global warming, I'm not quite sure. They're now calling it Siberia. So it's, and I saw the temperatures here in New York, it was like 40 degrees, I'm thinking, t-shirt weather. All right. But I thank you very much for coming. I thank David and Krista for the invitation. I've always loved this museum because there really isn't a museum that kind of fills this niche to tell people like, hey, you know, there's no coincidence that George Washington was inaugurated like next to the New York Stock Exchange. The end of Wall Street, there's a big church. You know, it's part of our culture, and not a lot of people understand it even today. So they're filling an essential role in educating people about the history of finance, and hopefully I can elaborate on that a little bit more in what I've been doing. But first of all, I want to start with a little bit of a conflict here. To many people in the United States, those in economics, those even in money management and finance, John Maynard Keynes, the economist, is to money what Chris Christie is to traffic management. He's a bit of a roadblock, and a lot of people have problems with his theories, and you know, they're debatable, and I'm not going to talk about that, or while I talk about Chris Christie, but I hope to give you some idea of not only sort of a capsule history of the last 100 years of finance through the eyes of John Maynard Keynes, but some advice you can take away from this talk that will help you today and really establish the relevance of what he's been doing or has done. I use that in the present tense because a lot of his advice and a lot of his experience is still very relevant. But let's go back 100 years to 1910. He was a lecturer at Cambridge University, King's College, and when I went over to Cambridge to do the research, I discovered in his lecture notes that he didn't know anything about finance. He knew nothing about investing. He wasn't born into money as a lot of people thought he was. I mean, he ended up Lord Keynes, but his father was a middle-class administrator at Cambridge University. Certainly didn't have a fortune, certainly didn't have an estate. He didn't really have much of anything, and he relied upon scholarships to get through Eton and then through Cambridge. And then he won a lot of awards, and his main thing was math. He was very good at math. He loved probability theory, and those are some of the themes that he explored in his academic pursuits, among other things. So 1910, Keynes is lecturing about finance, and he's trying to tell his students at Cambridge, well, this is how the markets work. You know, and he didn't really know himself. You know, it's kind of ironic. I'm reading this and thinking, wow, Keynes didn't know anything about markets when he was talking about it to one of the finest universities on the planet. So that was an immediate irony to me. But then he discovered some things along the way that were, maybe they were happenstance, maybe they weren't. But he started an association with a fellow named Oswald Falk, who was a broker in the city of London, with their financial district, their equivalent to Wall Street. And he formed a friendship, and they found out that they had a lot in common. Keynes loved to gamble, loved to speculate, loved to try out his probability theories. His whole idea was like, well, what's the certainty factor of doing this or buying this stock or making this move? So he's very excited about trying out his theories in the market. But the first thing he went into was not stocks, it wasn't bonds, and I'll get to that later. But first, there's an important part of Keynes' life that I think a lot of people ignore, is that, well, before World War I, he didn't really have any money. He was kind of staked, as he was given a stipend by his tutor, Alfred Marshall, the great Victorian economist, and his father to pay for his teaching at Cambridge. So he didn't really have a salary. He didn't have a PhD. There was no PhD program in economics. He wasn't trained as a money manager. So all the things that he would later learn, he learned really, it was kind of a, seat of the pants sort of approach. So he picked it up. He was, of course, brilliant, but he ended up training in this. So he goes into the government. He had this great degree from Cambridge. He was lecturing there, and World War I comes along, and he's appointed to a treasury position. to advise the Treasury on kind of how to finance the war. Of course, you know, World War I was horrible. End of the war, he's still working for the Treasury. And they asked him to sit in on the panel that's reviewing the Versailles Accord. Now, if you know from history, and we have some friends from Denmark that can probably tell you more about it than I can, the Versailles Accord imposed some very severe reparations on Germany, so that really Germany couldn't afford to pay them back. There's no way, you add up all the goods and services over the period, you know, the 20s, that they would ever be able to meet the Accord's stipulations. So it basically ensured that Germany was going to go broke and have some big economic and political problems, as we know. Now, Keynes, in 1919, quits the Treasury. He says, no, I can't stand this anymore. I can't deal with this. Writes a book, and I recommend that you all read this, called Economic Consequences of Peace. So the book really savages the Versailles Accord. It says, look, I've run the numbers. Germany can't get out of this. There's no way that they can face this horrible treaty that is imposed on them and survive as a country economically. Ironically, as I was walking in, I noticed around the corner you could see some of the certificates from the Weimar Republic in the 20s. You know, 1 million marked, you know, bond certificates. I mean, we think, oh, $1 million for a certificate, that's not a big deal. This is the 1920s, and that represented this incredible surge of hyperinflation that destroyed the German economy, destroyed democracy in Germany, and eventually brought Hitler to power. So Keynes was right there when they made that decision. He became a bad boy for writing this book, but it propelled him. It made him an international superstar. The book was a bestseller on both sides of the pond, and Keynes became, you know, this combination, Paul Krugman and every other media economist you can think of. I mean, he was really famous, and the money started pouring in. So Keynes said, you know, I need to invest a little. He had a pretty nice lifestyle with the Bloomsbury Group. His friends included Virginia Woolf and Picasso and Lyndon Strachey. I mean, the Bloomsbury Group is a study in and of itself, because these were like the cultural bohemians and the hippies of, you know, the post-World War I era. And they were the cultural leaders. You know, Bertrand Russell was part of that group. Just everybody you could think of who was an intellectual force of that time was connected to Bloomsbury somehow. But he wanted to be more than a party animal, which he was, and he wanted to invest the money, which he did. But the first thing he did was not to do something sensible, and a lot of people do this. He started picking currencies, and he started speculating on currencies, particularly European currencies, and he believed that, you know, the mark and the French franc and all these pre-Euro currencies were going to be devastated after World War I, and he was correct for a while. But in 1920, everything turned around. The mark rebounded, all his trades went sour. He'd been investing money for his family, Virginia Woolf and all these people, and he went bust. So 1920, the brilliant boy in the block, the guy who's, you know, the treasury guy, the inside guy, knows all these big numbers flowing through the economy. Nobody knew more than Keynes, right? He loses all of his capital. So he says, well, most of us would have said, I'm not going to do this again. But Keynes goes back into the market and says, I'm going to make all my money back. I feel it's a moral debt to these people to make this money back, and he does. So he's speculating throughout the 20s in currencies, but that's not enough for him. So what he does is he says, look, one thing I know about macroeconomics, and he was pretty much the father of macroeconomics, is that, you know, in a rising economy, keep in mind that Europe was in a recession a long time after World War I. The United States recovered pretty nicely in the 20s, but 1919, 1920, early 20s were very, very tough for Europe. There were people starving across Europe. But he knew that there was an economic recovery that would gradually take place. So he would invest in every commodity you can imagine. When I went to Cambridge, I discovered that he had thousands of commodity positions. I'd never read this in any of his biographies, and I had read most of them. Welcome. Thanks for coming. No problem. Please, make yourself comfortable. And then what happened was that he was speculating in all these different commodities: tin, lead, gold, oil, jute. How many people know what jute is? They make rope out of it. So an essential part of shipping, by the way. So he had all these contracts, and he was doing pretty well. Now this time, he was also managing the money of not only his friends, but he started up what we would now call a hedge fund, just with a specific goal in mind, just to speculate using a single strategy, which was commodities and to some degree the currencies. Not quite stocks, a little bit of stocks, and really not any bonds. Cambridge University asked him to manage their money. There were two British insurance companies that also asked him to manage money. So he's got a private syndicate, which was sort of the hedge fund. He's got his friends, he's got his family. He's got these two British insurance companies, which were very conservative, and King's College, Cambridge. So the guy who would later become known as this world-famous macroeconomist was actually a very active money manager, a very fervent capitalist. I mean, you can get into this argument with a lot of people, and they'll say, oh no, Keynes was a socialist. He was not. There's no bigger believer than Keynes in markets than this guy. It was amazing. So he's managing money mostly in commodities in the 20s. Again, using a macroeconomic view, demand for commodities, and he had access to all this data. There's some like 400 pages of one of his volumes of his collected works, which is 30 plus volumes. I went through a lot of this. I'm thinking, wait a minute, this guy was a real data wonk. He loved numbers. He thought he could like look into the numbers, see patterns and all this stuff based on his macroeconomic point of view. So what he did is he collated all this information. Keep in mind, this is before Bloomberg terminals, this is before Quotrons. I mean, this is before they had any of this data on the screen. It's all paper, right? So he gets it from the Treasury. He says, okay, I'm making all these bets. And he doesn't see what's happening in 28. He's got some inkling that something's wrong with the market at 28, but he doesn't quite know what it is. So he goes long on all these commodities. And his partner, Oswald Falk, gets out of the market at 28, gets back in at 29. So we all know what happens in 1929. Everything falls off the cliff, right? Keynes didn't see it coming. He just didn't know what was happening, and a lot of people didn't. I mean, you know, one of the most famous economists at the time, Irving Fisher, stocks have reached a permanently high plateau. Well, they didn't. I mean, they just went into the sink. So Keynes got wiped out again. All of his positions got creamed. I found out one position he was long in rubber for some reason. And he got really nailed in that. The stock positions got creamed. But again, he saw something and he learned something that few people do when they get crushed like that in markets. I mean, think about how many people were investing in 2008? Well, conservative bunch here. Wall Street. Anyway, so it was a horrendous time, and a lot of people just got wiped out. They said, no way am I ever going to get into stocks again. Shades of like the dot-com wall from 2008. I'm never going to go near Wall Street. I'm not going to touch this stuff ever again. But Keynes says, look, maybe my whole top-down view, you know, is wrong. Maybe my macroeconomic sense of what I thought was going on is totally mistaken. One of Keynes' most famous quotes is, and he had this argument with some guy who said, Keynes, you changed your mind quite a bit. And Keynes goes, sir, when facts change, I change my mind. What do you do? And he was kind of a nasty guy, but he didn't suffer fools gladly, and of course he had this ability to learn from some big mistakes. So 20 gets wiped out, comes back, gets into leverage, okay? 29, he gets wiped out again, starts buying stocks again. So if you're a true investor, you're thinking, well, how do I take another look at this? What's a better way of looking at this? And what he does is he starts looking at the enterprise value of stocks. And this is sort of one of the foundations of what we call value investing, which leads to Warren Buffett, Benjamin Graham, and from what I could tell in the archives, he never corresponded with Graham, who was, of course, the real intellectual brain behind value investing, and he was here at Columbia University and the mentor of Warren Buffett and so many other investors. So Keynes is saying, well, I should look at the value of the company. I should look at the way that they do business. Do they have any good protection against competition? Do they have an ability to create cash flow? He goes after dividends. Now, I looked at the portfolios and he was buying some really nice dividends, some stocks that were paying 6%. Now, when you consider in the 1930s that most income-oriented investments, think of anything out of a bank. I mean, we were talking deflation. We're talking about nothing, almost like what they're paying now. But it was, things were, the value of everything was dropping. So you couldn't get anything in a bond that was worth owning. It was negative value. He's buying 6%, 5% dividends, preferred shares. He's loading up on them. In the 1930s, when people were saying, look, I know people jumped out of buildings. I'm buying stocks, So Keynes was doing this with this new value, what we call a bottom-up focus, does really well. He's building up the portfolios of all of his different clients. King's College is doing well. Of course, the two insurance companies are doing well until 1937. 1937. Now, if you know a history of the Depression, it was actually a series of recessions. One of the biggest stock market rebounds or rallies happened in the early 1930s. Keynes was investing, which was a good time to be in. But 1937, there was some monetary tightening, and things went south again. There was another huge market decline, and Keynes again lost a lot of money, and he also had a heart attack that year, so he had to step back. But what happened again is he told his institutional clients, was like, look, I'm sticking to my guns. I'm picking stocks that are going to last a long time. They're paying dividends. I know the management. I've studied the management. I know how they make money, and they're going to continue to make money. Of course, later that decade, World War II starts. Churchill taps him on the shoulder and says, Keynes, do you mind going across the pond and asking the Yanks for some money? We have a little problem here with bonds and stuff. So he sent Keynes over to ask Roosevelt for some money. At this point, a lot of Roosevelt's administration adopted the Keynesian economics that we know today, stimulating the economy, creating what they call aggregate demand. That is, if I give you a job, you're going to go out and spend that money in the economy and create more jobs and pay taxes. And that's the classic Keynesian view. And Roosevelt started it, he stopped it, and we could talk about that for hours. But he was doing that. He was still managing money. He was backing off a little bit. He had a huge heart problem. And now he's starting to finance the war. And what happens again is, like, Keynes is the indispensable guy. He's not only raising money to help Britain defend itself, but he's still managing money. As his house is getting bombed in London, he's got to retreat to the country just to kind of avoid the bombs being dropped. And he's still trying to have a social life. So he was a pretty amazing guy. But eventually, the big takeaway from Keynes is that he was persistent. He adopted a new way of looking at investing, which was revolutionary. He went into stocks at a time when most institutional investors were only investing in real estate and bonds. I mean, they were so conservative. You really can't make money in bonds and real estate over time. He just, he had inflation, he hated inflation, so he found a way to derive the value of a company that creates earnings and dividends and can produce them over time. So he took a long-term view, but he was looking at certain stocks. And when I looked at the portfolios, they were pretty boring stocks. They're not, I mean, the tech stocks at that time were like Austin Motors, the old British car company, and Leyland, another car company. Those were the high-tech stocks in the 1930s, and Keynes was a big believer in them because he thought, eventually a lot of people are going to have cars in the world, and he was right. He would pick shipping stocks. He would pick industrial stocks, companies that made something that people would need. Metals companies, mining companies. I think I mentioned shipping companies as well. I mean, these are the very essential kind of companies that make an economy run that are so important today. Just look at any train going on the tracks. What's happening there? Well, that's global commerce, that's shipping. That's happening all the time, and it's always a good indicator of economic health. Keynes invested in companies like that. Now, to really kind of focus on some of the specific lessons that he had, and this is how it relates to all of us, and this is kind of the wonderful part about writing this book, is that I got to talk to some people who were directly influenced by Keynes. I got to see, well, I've been trying to get hold of Robert Shiller, who is the father of behavioral economics. Now, if you've studied any of that, it's basically saying that we can't know what's going to happen in the markets because the markets are kind of irrational. Keynes called them animal spirits. If you read his general theory, chapter 12, that's all you need to read, because Keynes said, look, we cannot predict what's going to happen because this doesn't make any sense. Market prices may not make any sense. People have emotions. They get plunged into stocks like, Twitter or Facebook or Pets.com. Name a bunch of stocks where there was no basis for the prices to be as high as they were, and the market eventually comes down and crashes. So Keynes said in the 30s, in the middle of the 30s, in this time when nobody was really taking stocks seriously, nobody wanted to invest, he was saying, look, pay no attention to that man behind the curtain, which Graham called Mr. Market. It's just this sort of global hive of emotion and sentiment, and the stock market is not the economy. And Keynes said that early on, and it led to this whole school, which led to Robert Shiller at Yale, who really made a career out of saying, look, behavioral economics is the study of what people actually do and how they act rationally in the market. So I caught him at a lecture of another Nobel Prize winner just before my book came out. I asked him to read it, and he did, and he liked it because I dedicated a whole chapter to behavioral economics. He was kind enough to write something for me. And then he won the Nobel Prize, which is really cool. But there's also linkage to some other great investors, to George Soros. George Soros loves Keynes. He loves what Keynes was doing early on in his career. I can't explain George Soros to you, but I know that Keynes was a huge influence. David Swenson, the great Yale endowment investor, if you read and nobody reads this, if you're an individual investor, his book on professional money management, you probably read David. It's just a class. Every chapter quotes Keynes. It's like, Keynes was right about this, he was right about that. And here's one of the best investors of the century, quoting Keynes left and right. And of course, Warren Buffett. I know that there's lineage. I asked Warren Buffett, it's like, how did Keynes influence you? And he said, not at all. And I find it hard to believe, and I challenge him on that. But there is a connection because he was talking about value. He was talking about buying good stocks in the 1930s. So was Ben Graham. I think they independently developed those ideas, sort of like Leibniz and Newton on calculus. But there might be some connection there for further scholars if you want to look into this. So this is something that's the huge legacy that we are living with today. And the last fellow who was really profoundly influenced by Keynes that most people didn't realize, including myself, was Jack Bogle, the founder of the Vanguard Group, which is the largest mutual fund company on the planet right now. Now, Bogle went to Princeton. He was there in the 50s, and read Keynes in the early 50s, in fact, and was really taken with his theories. And it wasn't so much the behavioral part of it, but his concept of enterprise value. He's kind enough to write a foreword for the book, and I suggest you read it if you're a serious investor. But he said, look, there's the market. This is what people think based on their emotions Apple is worth or Google is worth. And is it the same value as the intrinsic value of the company? Probably not. And that's what the value investors are saying. So these two worlds are kind of intertwined, not perfectly connected. But Bogle seized upon this idea in the 50s, creates the index fund, which is a basket of stocks, bonds, different securities, and it says the whole philosophy behind this is like, don't time the market. You won't figure it out. Buy huge chunks of the market. You're going to get market returns minus the expenses of the fund. The fund should be very cheaply managed, and that's what index funds are, when Vogel came out with the index fund concept based on his inspiration from Keynes, they called it Vogel's folly. They thought it was the stupidest idea in the world. Wall Street hated it. They thought the guy was going to fail. Now Vanguard sells more index funds than any other company in the world. So he's been more than vindicated. He's totally a lion of finance. But I encourage you to look at some of his writing because he's very common sense, and he's really democratized investing. And this all came from Keynes, where he was saying, like, don't try to beat the market. You can't figure out what these prices are really worth. Look at the companies. Look at solid long-term investments. Look at things that people need, will want, will buy over time. And that's pretty much leads us to Buffett and Bolton. And what's really interesting is that when I sent the manuscript to Jack Bogle, all I had hoped for is to have him read it and say, look, you're crazy, you can't say that. And just to kind of correct some things that I had done in the book, and that was the most I was hoping for. But he comes back to me and says, look, John, Keynes influenced my entire career. It was like, wow, I'd never heard that before. And he said, can I write a forward for you? I was like, yeah, sure. So he did, and it was really a blessing in disguise. But another thing that I would like to leave you with is like the whole idea of Keynes. And I've studied his whole life. I've read several biographies, and if you really want to dig into Keynes, read the 3-volume set by Robert Skidelsky. He's like the Robert Caro of Keynes, and it's just, there's more to Keynes than I could ever hope to cover in this book. And he was a fascinating guy, a polymath. He was good at like 3 or 4 different things. A major, I mean, if you were to ask me, and I've studied a lot of history, who were the most influential figures of the 20th century? Well, you know, Hitler, Stalin, the bad guys, and then the good guys, FDR, Churchill. And on that list would be Keynes, just based on his influence on economics and thinking and investing, which I think he's sorely neglected on. So I encourage you to look at this. So here's the message. We all need to know about investing, and certainly David and the museum are doing their best to educate people, and you can get all sorts of stuff on the internet. It's all out there. But the basic message is this. Investing should be something that you do infrequently. Don't obsess about, doesn't run your life. You forget about it because you've done it right. Once a year, we review your investments and index funds. I'd be happy to give you a little bit more insight on that. But you leave it alone, and you do the right things. You do it prudently. You keep your costs low. Maybe you look at it once a year. You have a plan. And you take the advice of Keynes. They asked him what his regret was, and he was a supreme workaholic. And he probably worked himself to death. They said, Keynes, what was your greatest regret? He goes, I should have drank more champagne. And that's my advice to you. Forget about money, drink more champagne, enjoy your life, and I'd be happy to take some questions. Yes, sir.
Very impressive speech, first of all. I have 2 questions. First of all, I want to know, there's rumors that Keynes and Hayek is very close friends. Is that true?
Yes, it was. In fact, a lot of people don't know this. Keynes and Hayek crossed paths quite a bit in England. Hayek eventually ended up at the University of Chicago. Keynes had lectured there in the early 30s. I actually tracked down this quote. I didn't know if it was true, but Keynes Hayek wrote a very kind assessment of Keynes when he died in 46. He said, you know, this is one of the greatest men ever, and he clearly admired him. And of course, Hayek, I think, had a little bit better picture overall in history because he lived a lot longer. He won the Nobel Prize, of course, and you know, his Austrian school is certainly probably in higher esteem right now in the United States for any number of reasons. But I think that they were intellectual rivals, but I think I know that Keynes was admired by Hayek, and that they certainly did very well. I know Keynes ended up a lot wealthier than Hayek, but that the whole idea that there were these bitter enemies, I didn't find it at all.
The second question is a tough question, I think. Without respite, I think the most careless market in the world is Chinese market.
Mm-hmm.
Do you think the Chinese market is a very successful market if you sir, without respect again, if you think that's a very successful market, I think half of the people in this room will get you because these 3 lines all from China yesterday. So do you think there's any experience can useful to the developing country which have really very, very higher power, government power country? Do you think Keynes' experience can have this country?
Well, let me address that another way. I think Keynes has a lot to say to China about markets because he was a big believer in markets, but he also thought that they should be regulated. He also thought that they should, his commodities experience proved that there's so many different disparities going on in markets. They should be open, they should be transparent, but they should be regulated so that everybody knows what's going on.
The point is, where is this line? Where is the line to tell me where is good regulate, where is over regulate, or dictate? So I don't know. Keynes, Keynes, I read Keynes a lot of books and papers. Well, I think he never told us which kind of problem, which kind of situation is a good regulate, which kind of one is a bad regulate. Keynes, all the series of Keynes is based on I think is American market or the Western market. Your American people is very lucky. You're born on a freedom market system. On the upside, we Chinese people, we just run away from more experience. So my question is, where's the line? Where is the line? Where is standard? Do you have any idea of this question?
I do, and it's such a tough question to answer because in here we've just gone through a whole raft of post-2008 regulations called Dodd-Frank. There's hundreds of rules that haven't been implemented yet. We just got the Volcker rule put in place. And it's a tough battle to know what that line is. How much is over-regulation, how much is under-regulation? But I can say this, with regard to China, the largest Keynesian stimulus is going on in China now. Spending on public works, creating jobs, handling the largest migration in human history. That's important to look at, but that's has to go hand in hand with looking at how markets work and how they work well. Keynes, a lot of people think that Keynes hated capitalism, wanted to see it go away. No, he wanted to improve upon it, but the way to do that is to have some rules that everybody follows. And that's the best way you can answer that is like, is there a very strict definition of what a good financial regulation is? No, but to have open markets, truly open markets, which we don't even have in the United States entirely, is to have a lot of different rules to play by. There have to be a lot of different things that say you can do this and that to avoid speculation, to avoid bubbles and things like that. And we haven't figured it out anywhere. So we're still working on it. Thank you very much for your question, though.
Thank you very much.
Yes?
Yeah, are there any differences in investing approach between Keynes and Ben Graham, or is it basically virtually the same?
Yes. Through Graham and Dodd came up with this whole regimen of value investing. If you read their classic textbook, Securities Analysis, they lay out everything. Now, Keynes had an intuitive sense of doing this, but he didn't really lay out the ground rules of what fundamental investing was. But he had the right idea, and I think they kind of developed this different view of investing around the same time, and for a good reason. If you want to know more about that whole school, you have to read Ben Graham's Intelligent Investor, which is sort of Graham and Dodd light. But he kind of lays it out for you as like, look, you could go crazy with picking the next stock du jour or the next, Apple and trying to find this, but you'll probably lose more money than you gain. So it's probably a better idea to stick with an index fund, maybe a value index fund where they're They already know what the rules are, and this is how we pick stocks. They'll do well over time, but you have to be patient. I think that was the enduring quality of both men, is that they suffered huge losses in the market crash, and they figured out a way to rethink being in the market and investing long-term rather than short-term, which is a problem that a lot of people have.
Were there actually index funds back when Keynes was investing?
Not really, but I saw in some of his notes that he favored an index approach. So we would talk about an index of industrial stocks that would sort of be a basket of stocks that he liked. It wasn't like the way Vanguard and iShares do it today, where they have every single stock in like the NASDAQ or the S&P 500. It wasn't like that. It was like tiny. I think there would more be like, it'd be like sector funds are today. It's just kind of slices of the market. But then there was the germ of that idea back then, and maybe that's what Mr. Bogle saw. But good question, thank you. Yes?
Every time I read Keynes, I always ask myself this question. So government spending as propelling the economy to improve. How does this, could you comment on justification of the U.S. trying to get into more and more military conflicts so that it's kind of increases government spending? Any ideas?
Well, Keynes really saw government spending not as a political, means to an end, but as a way to stimulate demand so that, and this does apply, unfortunately, to military spending, however, when you look at it, you do employ people, those people go out and pay taxes, they do create jobs in the service and consumer sector, so that part of Keynesian economics still works, but there's another side of it that says, well, is this a productive part of the economy that he didn't really address, that I suppose he could have addressed? And you could even argue that the recession or the depression in here in the United States was ended by a Keynesian stimulation called World War II. We had to ramp up everything to produce tanks and planes, all that stuff. And it did put people back to work, and they, effectively ended the depression, not in a good way and not in a way that anybody wanted to really do it, but it did work. So we take this example, from World War II, we take it from other periods of history where it's been applied. Europe, after World War II, of course, the Marshall Plan, rebuilding Japan, huge Keynesian theory involved there. But it's not a complete theory. It doesn't explain what happens, when government has to back off a little bit. There's no sort of exit strategy for this that Keynes, he only lived till 46, so he had no way of seeing what would happen in the 60s or the 70s or the 80s, or concerns with stagflation and all these other questions that he never really had a chance to see or experience. So in all fairness, he didn't really know what that would have been. Had he lived as long as Hayek, he probably would have had some sort of answer to that. It's like, well, this is where you kind of switch it more to private sector stimulus versus public, and that's something we still need to ask ourselves as a society. In the United States and in China. China's got this huge stimulus going on, and the people planning that economy have to say, well, what happens after our 5-year plan? Do we stop building subways? What happens then? We have enough jobs, we have enough people to fill the back. There's a lot of different things that are hard to plan on a big scale, but we still need to ask the questions. A very good question, thank you. Yes, sir.
Could you comment on maybe some examples, if you did see them, of how Keynes's knowledge of economics influenced his investment strategy and vice versa?
I love that question. The New York Times asked me that question. Now, I know that Keynes' experience as an investor shaded his entire view of economics, at least in the mid-30s. Now, if you read The General Theory, which is a god-awful book to read. It's just, I was on my desk for, I hate to say this, 2 years before I actually tried to conquer it. I had to get through it 3 times. But chapter 12 is where he talks about markets. So if you read that through the lens of Keynes' investing experience, having lost a lot of money, made a lot of money, knowing what worked, what didn't work, that's how it influenced that part of his theory. Now, did it enable him to come up with another theory to predict what markets were going to do at any given time? No, he never got there. And I'm not quite so sure he would have gotten there either, because he sort of backed away from this idea of using macroeconomics to predict what was going to happen with markets. So yeah, there was an influence on his theories. Now, did the theory come before his investing experience? I don't think so, because I think he had to actually get his hands on other people's money, lose it through leverage, gain it back, and know what was really a bad idea over time to know what this was about. But most of what we know about Keynesian economics is not about markets. It's about, labor economics, it's about monetary policy, it's about all these other things. But I think if you read that one chapter, just the prose changes from the rest of the book. It's like it's a separate book. And it's a wonderful section to read if you read nothing by Keynes. That is the part and you should get the edition with Paul Krugman's lovely introduction, because he spells out, kind of a modern version of what Keynesian economics is, and that's what I would suggest. So that is a very interesting question. I'm still exploring that. I had to query some economists on this, and they didn't quite have the answer, but the people are still exploring that. Thank you. Some other questions? Yes?
I don't know if you got into monetary policy at all, but what would you think his reaction to Bernanke's, what he's done over the last 5 years to fight the financial crisis?
I'm not an economist, and I'm not going to go there because I don't feel comfortable talking about monetary policy. Generally, I think he would have liked it because in its spirit, it was an economic stimulus. Has it worked? No, it really hasn't created that many jobs. Not as many as they would like. Will it work over time? I don't know. I wish I could help you out there. There's some other questions. Yes?
As we all know, the macroeconomic has a big influence on the stock market, but I'm so confused that in the past few years, the Chinese GDP grows so well, but the stock market, the index doesn't change that much, and that alone increased that much. Do you think that's because the Chinese market is not that regulated that?
Have your attention, please. May I have your attention, please? This is the Fire Safety EAP Director. We are conducting EAP training on the 5th floor at 1:30 this afternoon. There will be 2 sessions today, one at 1:30 and one at 2:30. All wardens, deputy wardens, and searchers need to attend one of these sessions. Again, this is the Emergency Action Plan Director. We are conducting EAP training today on the 5th floor at 1:30 and 2:30. All wardens and deputy wardens and searchers are asked to attend. Thank you, and have a nice day.
Thank you. At least they didn't clear the place out because of something I said. Just part of it. I'm sorry, please finish your question.
Okay. Is that because Chinese market is not that regulated, as you said before? But as I know, Chinese government tried a lot on this market. They want to change the market rules, and this year they issued some policy about the stock market, focus on the IPO. But it cannot change the market. So, what problem do you think is the biggest problem in Chinese market and make the Chinese market to feel that much?
Well, I'm certainly no expert on the Chinese market, but in general, for markets to function, one, you need to have complete price transparency on the companies listed. So everything about a company should be known and be audited by outside parties. You should have the ability to buy shares easily and sell them at any time. There shouldn't be any restrictions, and the market should be reflective of the largest possible group of investors in it. Now, if there's just a small, on Wall Street in the 1870s, 1880s, there was just a small group of investors the Jay Goulds, people like that, who are constantly manipulating the market. You can manipulate a market because the pool of investors is so small, then you're going to have a lot of disparities. Another thing I would say in general is that stock markets, as a rule, don't necessarily reflect the economy at large. So even though the Chinese economy is growing 7-8% a year, it may not be reflected in stock prices. And that's really, due to the pool of investors who are making those decisions, and we can't buy shares in the Shanghai exchange here. And maybe if that opens up a bit, it will change and we'll see different price movements. But generally markets should be as open as possible to work efficiently. If you look at, I advise you to study Eugene Fama's efficient market hypothesis writing and anything written by Burton Malkiel. It's the more people know about prices and companies and the real money that they're making and not making, the better off markets are. So I'm sorry I can't offer you more insightful information on your market, but that's in general how markets work.
Okay, you said there are two problems. First one is the pool is not that big. Second, maybe it cannot follow the GDP growth. It's natural. But the first question I can see, the pool is not that small because in China, almost many people are played in this market. And I'm a student at State University located in Shanghai, and many professors do some research about the stock market. But they don't think its pool is so small. But there are maybe some other problems. And as for the second problem, I think as we evaluate the company, we almost care about the long-term growth rate, using the PE evaluation of SASS evaluation. But in the long term, I think the GDP may have a very big influence on the value. So I think there may be some high relation between these two things.
You may be right, and I think you should keep watching this and keep learning about it because it's evolving. It's not something that's perfect. It's not perfect here. It's not perfect in Europe. And the thing that makes markets work is people and investors saying, look, we need this information. Please give it to us so we can have a decent way of pricing these stocks. So you're on the right track. Thank you very much.